Manish Kumar, Chief Investment Officer with ICICI Prudential Life Insurance, joins us live from our Mumbai studio. Manish, fantastic to have you back. Thank you for joining us.
Thanks.
Manish, first sketch the broad picture for us. Things exactly are not very favorable for Indian economy and Indian stock markets, but Nifty is less than 200 points away from an all-time high. What's going on?
Actually, if you have to break up Nifty, or not Nifty, but rather the overall markets into Nifty and rest of the stocks, then possibly what is happening is that top 10% of the stocks in the stock markets are at an all-time high or hitting new highs. And most of them are actually constituents of Nifty or Nifty Junior. On the other hand, 80 to 90% of the stocks are actually at much more reasonable valuations, and maybe you can say corresponding to index levels 30 to 50% lower than where they are today. So as such, index is not really giving a true picture of what is happening in the economy. There are certain companies, certain sectors that are doing well, either because of currency depreciation or because of the fundamentals of the sectors per se, and that is what is causing Nifty to remain where it is today.
Manish, what do you mind is happening with the entire FMCG space, and does it seem like soon enough when the valuations for names like a Unilever or for that matter ITC, Dabur, etc. are going to hit a ceiling and we will see some huge amount of profit taking setting in for these names?
We as a house, we tend to look at numbers very closely, and what we have observed in the FMCG space is across most of the companies, not just in the listed space, but also in the unlisted space, there has been quite a bit of slowdown, either in terms of volumes or in terms of price increases that have been happening in the past, and there are several companies that are also facing margin pressures. In fact, there are companies where the top line growth is very muted, but they are somehow managing profit growth with better margins, and there are companies where the top line is still reasonably healthy, but the margins are coming under pressure. So somewhere, because I think fundamentally the performance of most of the FMCG companies is likely to get challenged. But on the other hand, because of technical factors, which is primarily on account of Unilever buyback announcements, that we are seeing this kind of frenzy in some of these consumer stocks. Somewhere, what is also helping the cause of the sector is there are other sectors which are probably getting more challenged thanks to moves by RBI and thanks to statements made by Fed. So because of all those factors, consumer still seems to be hogging the limelight.
Manish, a core part of your portfolio is banking, and within the banking, your bias is clearly towards private banks. Are you worried about that exposure, or you think private banks can manage the short-term pressures which will hit them as the short end of the market now will move up and the cost of borrowing will only go higher?
The kind of banks that we are presenting today, these are banks that have established track record, they have seen cycles, and they have demonstrated that they have done well across cycles. Secondly, there are two kinds of challenges in the banking sector. One is relating to asset quality. Second is relating to liquidity and the fact that the interest rates may not come down in a hurry. Now, the banks that we are presenting today, most of these exposures or most of these banks have higher exposure to retail sector where the challenges are much less, and therefore on a relative basis we see much lower asset quality issues in these banks. Also, most of them have an excellent liability franchise, and therefore even in a hardening interest rate scenario they are likely to do relatively better. Therefore, from a relative or from a portfolio perspective, it makes sense to continue to remain invested in some of these banks.
Manish, what's the take on IT? Some surprises coming in from INFI as well as TCS just last evening.
Right.
What's the take on the sector now?
We are incrementally getting positive on the sector. Right now, our positioning has been somewhat neutral. In the past, we have taken some tactical bets, and that have worked in our favor. But going forward, I think there are two tailwinds that we are seeing for IT. One is that currency has already depreciated quite a bit, and it looks like every year will see some kind of further depreciation. Second is, after a somewhat soft patch of IT spend in the last 2 years, there are small signs of IT spending revival. At least the US economy seems to be doing reasonably well, and therefore, if that can be construed as a lead indicator, then probably with a lag we can see IT spending reviving in a bigger way. And if one has to combine the two factors, then one doesn't have a choice but to be incrementally positive on IT.
But are you in general worried about the polarized nature of this market? The narrow strength of the market is only holding on 10-15 consumer names, maybe 8-10 pharma companies and 4-5 IT stocks. That's about it. 95% of the market is still looking weak. 80% of the market is at an historic low, and for 60% of the market there are no takers.
I could not but agree with you on what you are saying just now. Yes, it is a worrying sign, and that has a lot to do with what is happening in the domestic economy. What is happening is that the investors in the last couple of years, we have had funds coming in from certain global investors who have been extremely focused on the quality of balance sheets and on the quality of growth, and they have chosen to invest in those 20 or 30 companies which actually satisfy those criteria. So as such, it is basically the nature of money which is chasing these kind of companies which has caused this kind of dispersion in valuations. So if this valuation gap has to correct, for that the Indian economy will actually have to come back, and some of the challenges that we are seeing on the domestic front will have to ebb.
Manish, we've seen some major outflows in the last 6 weeks or so when it comes to equities. Do you see this trend continuing?
Outflows from foreigners, you mean?
That's right.
I think what happened in the month of June was, of course, a direct consequence of the statements coming out of Fed, and subsequently there has been some flip-flop from Mr. Bernanke on that. But I think as a country, we'll have to be prepared for much more muted inflows on a net basis from foreigners going forward. Can there be some months of outflows? Answer is yes. But I think yet within the emerging market class, India still stands much better than some of the other countries like China or Brazil. Therefore, India will be a favored destination within the emerging markets. But as such, when we talk to global asset allocators, there is a preference for developed markets vis-a-vis the emerging markets.
Manish, where is the value in this market? Do you think there is a lot of value in beaten down and completely bruised metal stocks, or there is deep value in PSU banks, because most of the PSU banks now either are nearing their book value or are trading below their book value?
Right. To be honest, there is value in a substantially larger component of the markets, but we will have to differentiate between value where the challenges are huge and value where they are attractive just because people are ignoring the valuations. So there are companies in the banking space or in the infrastructure space or in various other sectors as well where there are values, but we'll have to be very selective, because what we believe is, because of what is happening in the economy, some of these sectors will continue to see the challenges. So for example, if there is a value in the PSU banking space, we would still choose to continue to stay away from that, because those challenges will keep coming to the fore. However, if there is a value in say some isolated export engineering theme, we may actually choose to look into it, because at some stage we can see growth coming back. If there is a value in the auto sector, we may still like to buy into it. Why? Because that is one sector which has been hit very badly by high interest rates and commodity prices in the last 3 years. And going forward, if the value is good and if we believe that this country's growth path will again come back at some stage, then probably it makes sense to be in those companies. So this is going to be very selective in playing value.
Okay, Manish, I'm going to ask you a difficult question. Based on the kind of outflows and inflows you've got in the first quarter of this year, can you put a number for us that this would be the total incremental inflow from your from your schemes or from your house into equities this year?
Well, in the month of, without getting into the numbers, in the month of June, we were net buyers as a house. Yet, if I have to take the call for the year, either for the house or for the industry, what is very clear is that the extent of surrenders have come down, although the flows have to pick up. Also, because the surrenders are happening in some of the older schemes which have higher equity exposure, and because the incremental flows are happening more in traditional products or in some of the other ULIPs with much lower equity exposure. Therefore, on a aggregate basis, insurance companies are likely to be probably I would say, even if they are net buyers, they will be net buyers on a very small scale.
But they are unlikely to be sellers. That is more important, I guess, because last year they were called the villains of the market.
Right. So definitely the overall position this year from the insurance companies as a whole will be much better than last year in terms of delta. But we do not see the insurance companies on an aggregate basis to emerge as big buyers.
Okay, Manish, good chatting with you. Appreciate you taking the time out and speaking with us today and as to